Hello, hello. Okay, so we're moving into chapter 2. Chapter 2 is going to talk about something close to my heart because this is what I did for 25 years as a professional accountant. Job order costing. Job order costing systems are used typically when you have individual projects or products that are unique. So many different products are produced for the period. The unique nature of each order requires tracing or allocating costs to each job and maintaining cost records for each job. So job order costing, cost flow goes like this. We requisition direct materials. They go into job 1, job 2, job 3. We requisition direct labor. We have direct labor. And again, they get a portion to each job. And then, of course, we have to calculate manufacturing overhead, indirect costs. Remember, those are the things that aren't directly traceable to the product. And they also have to go to each one of the jobs individually. This is the way we keep the cost records. We do a job cost sheet. Now, this is would be a paper one. In most software, obviously, you're going to bring up a picture like this, but it's already going to be done by the computer. So in a job cost sheet, you've got a unique job number. You have a department. You have the item. What are we creating? In this case, wooden cargo crates. We have the date started, date completed, and how many units were completed as well. Coming down here, we have a section for each of our major product costs, manufacturing costs, direct materials, direct labor, manufacturing overhead. On the bottom is our summary of costs where we can get our total and we can get a unit product cost and it will help us to figure out how are we going to price this? What are we going to charge the client? So the first thing we get is a requisition for materials. We have to have something to start with. We have a requisition number, which is again unique to this particular requisition. Here's the job number. Now this job requires two things from the warehouse. 2x4s, because we're building crates. So we need 2x4s that are 12 feet long. We need 12 of them. And the unit cost is $3. So our total cost for the 2x4s is $36. We also need 1x6s. They're also 12 feet long. We need 20 of those. And those cost $4 a piece. So 20 times 4 gives us $80. So our total requisition cost for this job is $116. And we're going to add that to our job cost sheet. There's direct materials, there's the requisition number, and a total of $116. We're also going to bring it down here into the cost summary because we're not going to use, or rather, we're not going to request any other materials. That's all we need for wooden cargo crates. Next is going to be direct labor. And for that, we're going to use an employee's time card. Here's our employee. I am skilled. The way they come up with these numbers, these names. The time ticket, this person started at 8 o'clock in the morning. This is naval time. So ended at 1600, that's 4 o'clock in the afternoon. We have a total of 8 hours completed. This person makes $15 an hour. So we have a total direct labor cost of $120. And here's the job number. Very important on a time ticket. When I was working in architecture, I did that for about 10 years. I had architects who'd sometimes work on 3 or 4 projects the same day. So it was important on their timesheet that they recorded how much time they spent on each job. That was how we allocated the cost. So we drop that into the direct labor section and we bring the 120 down here into the summary. The last thing we need, manufacturing overhead. Now, we need to use an allocation base for manufacturing overhead. Why? Because it's impossible, or difficult at least, to trace overhead costs to particular jobs. Remember, that was our definition of manufacturing overhead, that they were costs that were related to production but not directly traceable to the product. They could be direct labor hours, could be direct labor dollars, could be machine hours. Now the POHR, the POR, is used to apply manufacturing overhead. So we need a rate. And this rate is going to be based on the allocation base, on the driver. To calculate the POHR, we're going to take the estimated total manufacturing overhead cost, so the estimated overhead cost for the period, and divide it by the total estimated allocation base. That's our driver, right? What's the cost driver here? What is the main thing that's causing costs to increase? So we're going to divide the total of those units into the total estimated manufacturing overhead cost. Predetermined overhead rates that rely upon estimated data are used mainly because actual overhead for the period typically isn't known until the end of the period, and you can't wait till the end of the year to get the total cost for a product that you're producing for a client today. We need a number today, a cost, because the price that you charge your client is typically going to be based on the cost to you and then a markup of some sort. So we have to have a number. So we estimate. And we estimate using an equation that you've seen before, right? Y equals A plus BX. We used that when we had a mixed cost in Chapter 1. Y, again, is the total estimated manufacturing overhead cost. A is the fixed portion. B is the per unit cost. And X is the activity level, the allocation base. So we're going to look here at PAIRCO. PAIRCO estimates it will require 160,000 direct labor hours to meet the coming period's estimated production level. In addition, the company estimates total fixed manufacturing overhead at 200 and variable manufacturing overhead costs of 275 per direct labor hour. So we have a mixed cost here. That's why we're using the formula. So for purposes, we bring up the formula. A, the fixed portion is 200 grand. B, the per unit, 275 per direct labor hour, times the estimated activity of 160,000 direct labor hours. So this gives us 440,000 plus 200. So our total estimated manufacturing overhead is $640,000. Remember, the formula for POR is the total estimated manufacturing overhead divided by the total estimated driver, in this case, direct labor hours. So we're going to divide the $640,000 we calculated here by 160,000 direct labor hours, and we get a POHR of $4 per direct labor hour. Now we have a rate that we can multiply times something we're going to have to give us an estimated manufacturing overhead. So in this case, we had 8 direct labor hours for A143. We multiply that times our manufacturing overhead rate of 4, and we get $32. We come down here, plug the $32 in. We now have a total cost for the job. Next, we're going to see that we completed 2 wooden cargo crates. So we're going to divide that. we're going to divide that 268 by 2, and we come up with a unit product cost of $134. So each one of them cost $134. So now we've got a new example. Dixon Company has 2 production departments, milling and assembly. So since we have 2 departments, now we're going to have 2 POHRs. We're going to have one for each department, and you're going to see why in a second. The company uses a job order costing system and computes a predetermined overhead rate in each production department. The predetermined overhead rate in the milling department is based on machine hours, because what milling does is milling takes the log and cuts it into lumber. And that's done with machines, mostly. Yeah, people run the machines, but the driving cost there is running the machines. And in the assembly department, it is based on direct labor hours. And we know assembly, what does that mean? It means putting stuff together. That's going to be done by hand. So that's labor. The company uses cost plus pricing, which essentially takes the total cost of the product times 75%. We add that 75% number to the cost, and that gives us our price. So in this case, we're looking at the milling department has 60,000 machine hours, 8,000 direct labor hours. That's where you can see, that's why we're using machine hours in the milling department as the driver, the cost driver. The milling department has total fixed manufacturing overhead of 390,000. It has a variable manufacturing overhead per machine hour of $2. In the assembly department, they're using 3,000 machine hours, but 80,000 direct labor hours. Again, hence the direct labor hours as being the driver for assembly. They have $500,000 in total fixed manufacturing overhead and a variable manufacturing overhead per direct labor hour of $375. So now we have all we need to calculate the costs here. First step is during the current month, the company started and completed job 407. It's important to note that it was started and completed because that's when we're going to need the cost. It wants us to use predetermined departmental overhead cost and rate for the milling and assembly. So the milling department had $390,000 of fixed manufacturing overhead. It had a $2 per machine hour cost times 60,000 machine hours. So our total manufacturing overhead cost for milling is $510,000. Assembly had $500,000 in fixed cost and had a direct labor hour cost of $3.75 times the 80,000 direct labor hours. We have a total manufacturing overhead of $800,000 for assembly. That gives us our numerator for determining the POHR. The denominator for the milling is going to be the 60,000 machine hours. For assembly, it's going to be 80,000 direct labor hours. So we're going to divide each of these total manufacturing overhead numbers by the drivers, and we get $8.50 per machine hour for milling and $10 per direct labor hour for assembly. And that's our POR. Those are our rates that we're going to use for that particular project. So now we come into job 407. Job 407 has 5 direct labor hours for milling, 20 for assembly. It has total materials, $800 for milling, $370 for assembly, $70 in labor cost, direct labor cost for milling, $280 in direct labor cost for assembly. Then we need to calculate the POHR. So we're going to take 90 machine hours in milling times the $8.50 per machine hour gives us a predetermined overhead of $765. In assembly, it's going to be 20 times 10, so we have $200. So now we have $765 of manufacturing overhead applied for milling, $200 for assembly. Now notice we're using the word applied here. We're using applied because this is what we're allocating to these two departments. The actual manufacturing overhead cost is yet to be known. So we add things up and we have a total cost for job 407 of $2,485. Now we have to calculate the price. So we're going to take that $2,485, multiply it times our markup of 75%. That gives us $1,863.75. We add that to the total cost, of $24.85, and our selling price for this job is $4,348.75. It is important to emphasize that using a department, if we think about it, if we used a single POHR as opposed to the double POHR, remember looking at there were more machine hours used in milling, there were more direct labor hours used in assembly. If we only used one number, it would be far less accurate than using a number for each department because of the way the costs are driven. This is something, ABC is something we're going to talk about in another chapter in detail, but they're bringing it up here, so we'll talk about it for a second. Activity-based costing is an alternative approach to developing multiple predetermined overhead rates. Managers use activity-based costing systems to more accurately measure the demands that jobs, products, essentially what ABC does is it takes some things that we typically think as a period cost and says part of that or all of that belongs in the product cost. So it's looking at everything the company does, not just the factory costs, but everything, and determining how much should be part of a product cost. It's going to become more clear when we look at that chapter. The amount of overhead applied, remember we said applied, not actual, during a period will differ from the actual amount of overhead costs incurred during the period. So what we're looking at here is we estimated something, then we're going to see the actual, and either the estimate is going to be lower than the actual or it's going to be more than the actual. If the estimate is lower than the actual, it means we put less cost into the product than we should have. That's going to be called underapplied. If we apply more cost than there actually is, that's going to be called overapplied. And each of these situations has to be taken into account at the end of the period. Although our attention is focused upon manufacturing applications, it bears re-emphasizing that job order costing is also used in service industries. And I explained that. That was most of my career, was using job order costing for architects, for engineers, for software developers. A lot of different companies that were project driven. Rather than making one product and flowing it through, we were doing all sorts of projects. And we needed to allocate that. The reason that we needed to allocate the costs is because the company as a whole might be very profitable. Individual types of projects or individual projects for clients might not be profitable, and we needed to look at that. So if working for a particular client doesn't bring in the profit margin we're looking for or is a loss, then we need to determine, do we want to continue working for that company? Do we want to raise the prices we charge to that company? We need to look at why that is. What's the purpose? This is the managerial part of managerial accounting, right? All right, that takes care of Chapter 2, job order costing. Chapter 3 is going to go into a little detail of more of the accounting side of job order costing. And again, please take advantage of the fact that I am available to you. No one in this class has yet contacted me, but you have my cell number. If you're having problems during homework, send me a text. If you want to have a meeting, I have office hours by Zoom. I have office hours on campus on Tuesdays if you want to meet then. But let's keep in touch and let me know how you're doing. I'm always interested, and have a great week.